Oh, hey, sorry. I was finishing up balancing my root chakra, to get kind of grounded. Alexa, cancel. As I said, we're long overdue for a market recap, folks. It's been a long time. A lot's happened between now and the last time we talked, mostly good. We've had some ups and some downs, but it's been mostly good since we got back into stocks on March 12th. So I want to review kind of where we've been, some things that we were doing, some things that we are doing generically outside of our hedge fund product for you and your general accounts or your separate accounts clients. You will know specifically what I'm talking about, changes we had made. Anyways, Keith and I just had a conference call. We're on the phone for an hour, so it's a good time for us to recap. Keith Zeke Brickman is my partner, of course, who some of you have met, some of you have not. Okay, so Keith and I, from an overall market perspective, again, we're starting with that triangle, right? So we're going to take a top to bottom approach. Macro perspective, we'll use the S&P 500 as our proxy, like we usually do, even though we look mainly at individual names and/or industry group ETFs, where we can get exposure to names that we want. So S&P 500, right? We've identified three phases since we entered since this bear market or pandemic or whatever you have it. Since we hit highs on February 19th, Keith and I have identified three phases, and we think we're in phase three. Phase one was to simply take off risk. Right, that was when when we were heading towards those highs. You remember me back in November, December. You're all screaming at me. I'm going into Treasuries, gold, the BND, Vanguard, boring crap that usually earns you 2-3%. I'm just making that up. Well, you know what? I didn't know anything other than the fact that the market was trading at 19.67 times forward earnings. And PEG ratios, which is another thing we watch for growth names, were out of whack. So without delving into that, you can go back, you can reference my blogs from back then. I've been being defensive for a long time now. And then on March 12th, after we hit those February 19 highs, on March 12th, if you remember, we took off some of those safer trades, right? We took off basically a third of a position in those safer trades, and we dipped our toes back into stocks on the 12th, and we gave you some sector picks and some specific name picks that I will quickly review. So we think we're now in, we had phase two, which was the panic phase, which is when we hit those lows ultimately on March 24th, which is when people are just like, I'm out, and or institutional investors and or other, retail investors were getting margin calls and simply had to just sell to meet their margin calls. I'm not going to get into that. I mean, some of you understand that, some of you don't. It doesn't matter. What matters is that there was panic, and it's hard to put any type of rationality or quantitative analysis in a panicked market. That now we think we're in a more stable trading range phase where, I think that people have the panic's over, and there's a lot of comfort in the fiscal and monetary policy from a global perspective that governments and or institutions have put into place, i.e. the Federal Reserve. What's going on here is unprecedented. Unprecedented time, it's required unprecedented measures. As I wrote to some guy in Barron's who I read every week, last week we went at it a little bit on email. I basically said, cheer up, Francis, lighten up, Francis from Stripes. Why does this surprise anybody? After QE 1, 2, 3, right, in the housing crisis, why does this unprecedented? This is the new paradigm, people. We have an immense backstop from the government, and you know what? I'm going to be really simple here, and you guys could argue me 9 ways to the sun. The government can print as much freaking money as they want. All right, you can argue that we can't have the bull crap. All right, they will print as much money as they need or want. Will that come down to bite us down the road? I don't know. Okay. Anyways. All right, so we're in a very comfortable trading range here. We believe, Keith and I believe, what do we know? Okay, we don't know anything about this second outbreak or how consumers will react, once businesses reopen, i.e. will they just continue to shop home? Will they go to a restaurant again? Or will they be getting Chick-fil-A, on pickup? Who knows, right? But regardless, we believe we might not even get those chances to buy stocks again at those markets. We don't even think we're going to go that low again. We don't see a V recovery, which is what all your physiques should look like, but we see a W recovery, right? So, like a couple more ups, back downs, back up, it's going to be a longer recovery. But still, we think we're in a pretty comfortable place or comfortable trading range here in the market. The level that we're watching now, which had become resistance once we broke back through it, and I told you this was our big pivot point, is for the S&P 500 index is 2650. Okay, now there's an old saying on Wall Street that now that old resistance, once we broke down below it, is going to become new support. So that's where a level that if we sell off again, which we think we will, we would buy stocks that we like again at that 2650 level on the S&P 500 holistically. Now I'll get into the sectors that we told you about that we went overweight on March 12th. Information technology, or the XLK Spider product, which gives us exposure. 32% of it is in those 4 core names, including Microsoft and Apple, that we love. Within technology, Keith and I have really started to like semiconductors on top of those names. So we've stayed long Microsoft, Apple. We've stayed long NVIDIA, which is a gaming chip play. A lot of the kids out there, your kids would know more about NVIDIA than we do. We like Micron. Now, as far as a 5G / broadband play, we're doing very well for you there. Okay, there's 2 things going on here. There's a 5G play, which is kind of on the back burner right now. Like, who the frig cares about 5G? We can't even find toilet paper. But 2 names to keep an eye on that we love: Skyworks, SWKS is the ticker, and Cuervo. They're 2 semiconductor plays that have to do with broadband. That's the easiest way to think about it. What's the government doing? Now they're allowing more access to high-speed broadband to poorer areas, to urban areas. It all fits into that play. Then as a bonus, you have the 5G play down the road. These names are involved. So we're adding semiconductors that we like there to technology. We don't really know what to do there. So we've stayed 100% long on the XLK names. We also told you about XLP, which is consumer staples, okay? We have lightened up roughly 50% on the consumer staple names we like. We told you about Amazon at 1649. That's where we put a full position on in Amazon, AMZN. Well, Amazon, we believe, was fairly we have sold out of Amazon. Now, I'm not saying for longer term you should do that. If you're holding on to it, just hold it here. Don't add, don't sell. Maybe lighten up a little bit if you want to raise some cash. If it gets back down to 2200 to 2210, that's a normal move in Amazon. People, don't laugh at me. We trade these all day. That's where we would get aggressive again. We would, as a baseline, keep a 50% position in it right now. If you're still long it where we told you to buy it, or even lower, maybe you reduce it to 50% up here. Look to buy it back when it comes in a little cheaper, or just invest with Keith and I. You don't have to worry about any of this. So we told you about Amazon. We told you about Target, Kroger, Costco, Walmart. You're up big in all those if you bought them when we told you to buy them. We have maintained 100% position in those names. There are some names we're betting against in our hedge fund, namely Kohl's and Gap. If you own those names, get out of them. We don't like them. But anyways, Target, Kroger, Costco, Walmart are the XLP names, or the consumer discretionary names we like. We are at a 50% position in the XLP. We've reduced there for the most part. Then we told you about healthcare, or the XLV. Within healthcare, we liked managed care, which are basically your insurance companies. We liked UNH and Cigna. We got into UNH at 205-ish. We got into Cigna at 150-ish. When we told you about those, we initially got hurt in those names. Then Bernie got sent back to the farm. Some other things happened, and they're doing pretty well. We have sold 50% of those positions. We will buy them back as they come back in here, but we are reducing those names now. But overall, we still like UNH and Cigna of the healthcare plays. And we like Gilead Sciences. You saw they had some positive COVID news, not for a vaccine, but for an actual treatment with one of their existing drugs. It would be another indication. So Gilead's a name. We wouldn't chase it, but Gilead, UNH, Cigna are the 3 that we like there. And people, we have some new news. Keith and I, we like to find sectors that present good relative value and names that we believe in those sectors. We believe, you're going to laugh, energy. We are looking hard at energy and financials. Okay, if you want holistic plays on these names, again, that give you diversity and exposure, you would buy the XLE, the Spider Energy ETF, which has a lot of the integrated names. It pays a good yield. It's a safer way to do it. Or you would buy the XLF, which is the financial ETF. We wouldn't initiate more than a third of a position in any of these right now, but we're looking at these two sectors as a good relative value play. We're starting to get our feet wet. We are buying a third of a position in the XLE Energy and the XLF. If you want specific names, I shouldn't do this. We like JP Morgan, State Street, Bank of America. We believe the dividends are safe. We think B of A is underappreciated. State Street's a custodial play with a 4% dividend. They had a decent quarter. They have a very sticky business. It's a stodgy name, but we like it. Solid. JP Morgan. It's JP Morgan. JP Morgan and Goldman Sachs, we love those two names. Energy, we like Hess and we like a couple other, I'm not going to we don't really have a great edge there, to be quite honest. So we're trying to leverage, Keith and I have a ton of resources on Wall Street. So we're trying to leverage the best resources we can to find some individual plays there. So we have parked some money in the XLE till we find those individual names. That's another good way to do this. That's what a lot of institutions do, to be honest. They'll just park their money in an index play until they find the particular names that they want to get invested in. That's about it as far as a market recap. I hope, foremost, everyone's families are healthy and happy. I know I was goofing around with songs this morning and all that stuff, but just goofing around. I was goofing around about 88. I don't like to put categories in and that stuff. As a matter of fact, I have a magnificent partner in life who's a magnificent health life coach who, guides me along the way here. But it's so important right now to stay healthy. I can't emphasize that more. Keep your immune system strong. Just be trying to get as much exercise as you can. I think this has been so great. The stories I hear about just grounding, family grounding, and spending time with your kids, and seeing people that I love spend time with their kids, and my kids. I love you to death. I love you all, and just be safe. And you're part of our wolf pack. So go get them.